Here back again making another video related to one of your homework assignments, that is P1032A. The objective of this assignment is to journalize entries for the disposal of plant assets. So Ellie Johnson Associates surveys American eating habits. The company's accounts include land, buildings, office equipment, and communication equipment, with a separate accumulated depreciation account for each depreciable asset. During 2018, Ellie Johnson Associates completed the following transactions. As you see here, the transaction included January 1st, purchased office equipment, $113,000, paid $80,000 in cash, and financed the remainder with a note payable. I'll be going back to the transactions as we go over the problem. So if we look back at plant assets, they are plant assets are long-lived, tangible assets used in the operation of a business. Examples include land, buildings, equipment, furniture, and automobiles. Plant assets are unique from other assets such as office supplies because plant assets are long-term, lasting several years. This requires a business to allocate the cost of the asset over the years that the asset is expected to use. This allocation of a plant's asset cost over its useful life is called depreciation and follows the matching principle. The matching principle ensures that all expenses are matched against the revenues of the period. Because plant assets are used for over several years, a business will spread the cost of the asset over several years. All plant assets except land are depreciated. We record no depreciation for land because its value typically does not decline with use. So as you recall, in the transactions, in January 1st, the company purchased office equipment of $113,000, paid $80,000 in cash, and financed the remainder with a note payable. Plant assets are recorded at a historical cost, the amount paid for the asset. This follows the cost principle, which states that acquired assets and services should be recorded at their actual cost. Record this entry, the company will capitalize, which is increase in asset account, the office equipment for the total cost of the equipment of $113,000. It will reduce its cash account by the total amount of cash paid, $80,000, and will increase a notes payable liability for a difference. So basically, you take the difference of the cash paid and the cost of the office equipment, you subtract the two numbers to get the amount for the notes payable. The resulting journal transaction or journal entry will be a $33,000 amount for notes payable. So if you go here, it'll be a debit in office equipment. For the office equipment, debit in office equipment of $113,000. It'll be a credit in cash, we're paying in cash. And then the remaining, which is a credit and notes payable. As I mentioned, that is basically office equipment, $113,000 minus cash, $80,000 for notes payable of $33,000, a credit of that amount. So the explanation for this journal entry is record purchase of office equipment with cash and note. As we see here. Okay, so on to the next entry. So in April 1st, if you look at both sides of the problem here, in April 1st, we acquired land and communication equipment in a lump sum purchase. Total cost of the land and communication equipment was $310,000. An independent appraisal valued the land at $244,125 and the communication equipment at $81,375. As is the case for the April 1 purchase, a company may pay a single price for several assets as a group, a lump sum purchase, sometimes called a basket purchase. For accounting purposes, the company must identify the cost of each asset purchased. The total cost paid, 100%, is divided among the assets according to their relative market values. This is called the relative market value method. You must go ahead and complete the table below to calculate the cost of the land and communication equipment using the relative marketing value method. So here in the problem, you have the journal entry, but does not give you the table. That's something if you do on your own, you'd have to write down on your own piece of paper. So this is a picture of the relative marketing table. So here, as we mentioned, we purchased land appraised at 244,125, communication equipment at 81,375 for a total cost of $325,500. Land, as you see here, in the market appraised value was 75% of the total cost. Basically, what they did was you take the 244,125 from the land, divide by the 325,500, produce a percentage of 0.75, which is 75%. So you see here, land makes up 75% of the total value. With the communication equipment, you take 81,375, divide by 325,500 to produce a answer of 0.25. Therefore, the communication equipment is 25% of the total value. As you recall, in April 1st, the total cost was $310,000 paid in cash. So since the land is 75% of the total value, we take the market value, 244,125, multiplied by 75% to get a cost of 232,500 for the land. Here we take 81,375, the market value of the communication equipment, multiplied by 25% to get a cost of each asset of the cost of the communication equipment of 77,500. This totals the total amount paid in cash of 310,000. So now I'm going to take these amounts and produce my journal entry. Take the amounts from the table we produced. It'll be a debit in land, not the market value, but what we paid for, which is 232,500. Also be a debit in communication equipment, which is 77,500. Then it will be a credit in cash, which, as you recall, is the total amount of 310,000. So the explanation or the purpose of this journal entry is to record the purchase of land and communication equipment with cash. Okay, so on to the next transaction, September 1st. We'll focus on here, right? It'll be here. September 1st, we sold a building that cost $520,000. The accumulated depreciation of the building was $285,000 through December of the preceding year. Ellie Johnson Associates received $420,000 in cash from the sale of the building. Depreciation is computed on a straight line basis. This building has a 40-year useful life and a residual value of $25,000. Before we record the sale of the building, we must record the depreciation of the building through September 1st, 2018. As you recall, let's look at the right side of the, let's look at the Word document here so you can see all the steps. Plant assets remain on the business books until they are disposed of. If the asset is no longer useful, it is disposed of. This requires the business to remove the asset and associated accumulated depreciation from the books. In addition, a gain or loss might be recognized by the company. Regardless of the type of disposal, there are 4 steps. First, you bring the depreciation up to date. Number 2, you remove the old disposed of asset and associated accumulated depreciation from the books. Step number 3, record the value of any cash received or paid in the disposal of the asset. And step 4, finally, determine the amount of any gain or loss. Gain or loss is determined by comparing the cash received and the amount value of any other assets received with the book value of the asset disposed of. To begin, I'll go back here. To begin, we must bring the depreciation up to date by recording depreciation on the building from January 1st, current year, the date of the sale was September 1st. We are told that the depreciation is computed on a straight line basis, that the building is a 40-year useful life and a residual value of $25,000. Don't forget that we must alter the annual straight line calculation formula to account for the fact that we are only recording depreciation for the part of the year. So if we take the formula, the straight line formula is cost minus residual value divided by the years of useful life, multiply the number of months used, divide by 12 to produce the straight line depreciation value. If you look back here, we have a cost of $520,000. Subtract the residual value of $25,000 divided by the 40-year useful life, multiplied by the 8 out of 12, 8 months used out of the 12 months in the year to produce a straight line depreciation of 8,250. So now I can go back to my journal entry. I can go ahead and use the partial year depreciation amount I calculated in the preceding step, record the depreciation on the building through September 1st, 2018. Will be a debit in depreciation expense for a building and a credit in the accumulated depreciation for a building in the amount of 8,250. The purpose of this journal entry, record depreciation on the building. Okay, that should be in the last line down here. Record depreciation on a building. So back to this here. Now we can determine the amount of any gain or loss. Gain or loss is determined by the company by comparing the cash received and the market value of any assets received with the book value of the asset disposed of. I will go ahead and complete the table below, determine the gain or loss on the disposal of the building. I will make sure to add the partial year depreciation amount we just determined to the accumulated depreciation balance on January 1st of the current year, which is also given to determine the accumulated depreciation on the building at the time of the disposal. Basically, we'll take the 285,000 amount, and then we'll add the 8,250 from the depreciation. So back to my table here. We can look at the transactions just to verify what we need for September 1st. So we sold the building. The cost. Sold the building that cost $520,000. Accumulated depreciation $285,000 through December 1st, the preceding year. Ellie Johnson Associates received $420,000 cash. The sale of the building. Depreciation is completed on the straight line basis. And then the building, as we remember, has a residual value of $25,000. So all that information will go here. The market value of a cash received, as I mentioned, is $420,000. Less the book value of asset disposal of costs, which is $520,000. Less the accumulated depreciation, which is $293,250. If we look here, we have the amount of $226,750. And then with these amounts, we figure that the gain we made was $993,250. So I just wanted to go back here to the icon, Work Solutions, just to look over all those amounts again. So these are the amounts given, right? Market value of assets received, 420,000, less the book value of asset disposed. The cost of the building was 520,000. The accumulated depreciation, as I mentioned, is the sum of 285,000 and 8250, which gave me the value of 293,250. Basically, what they did was they take the 520,000, subtract the 293,250 to give me the value of 226,750. Then we subtract these two amounts here to produce the gain of 193,250. Now I'll record the sale of the building on September 1st. Remember, this entry should show the building and related accumulated depreciation account being removed from the books, in addition to the receipt of cash for the building and resulting gain, as calculated earlier. Recall the normal balances of the accounts needed for the entry and whether a debit or credit is required to show the increase or decrease in each account's balance. Now I will record the entry. Go down here. As we recall, received the cash in 420,000. We debit in cash. Also be a debit in accumulated depreciation for the building of 293,250. It'll be a credit for the building, 520,000. And a gain in disposal, as we figured out, it was a gain of 193,250. So the purpose of this journal entry is record the sale of the building. Okay, on to the next journal entry. On December 31st, we'll be recording depreciation on communication equipment. Communication equipment is depreciated by the straight line method over a 5-year with a 0 residual value, as you see in the directions here. Remember that the communication equipment was purchased on April 1st, current year, and was recorded at the cost of 77,500. So if you go back to the previous cost, right, when we did our calculation, 77,500, cost of each asset. It's back to the problem. Since the asset was purchased mid-year, we must use our modified straight-line depreciation formula to calculate the partial year depreciation on the communication equipment from April 1st, 2018 through December 31st, 2018. So as you recall, the formula is cost minus residual value divided by useful life in years multiplied by the number of months to find the straight-line depreciation. So the equipment was 77,500. Equipment has a 0 residual cost, 5 years in useful years, 9 months out of the year, which gave me a straight line depreciation of 11,625. Using the amount I computed in the preceding step, I will then record the communication equipment for 2018. It is a debit and depreciation expense for communication equipment, 11,625. Credit and accumulated depreciation for office communication equipment, 11,625. The purpose of this entry is to record depreciation on the communication equipment. Okay, last but not least, December 31st, recording depreciation on the office equipment. Office equipment is depreciated using the double declining balance method over 5 years with a $1,000 residual value. An accelerated depreciation method expenses more of the asset's cost near the start of the asset's life and less at the end of the useful life. The main accelerated method of depreciation is the double declining balance method. Double declining balance amounts can be computed using the formula below. Remember that the accumulated depreciation balance at the beginning of the first year of an asset will be $0. This amount has been entered into the formula, and the office equipment was purchased on January 1st, current year, for I believe was $113,000. Thus, we must calculate and record a full year of depreciation for 2018. So you see there, office equipment, 113,000. That's already given. I'll go to this formula here. Double declining balance formula is cost minus accumulated depreciation multiplied by 2, multiply 1 divided by the useful life years to produce the double declining balance depreciation. In this case, we have a cost of office equipment in $113,000 subtracted by a zero amount of accumulated depreciation multiplied by 2, multiplied by 1, divided by the 5 years of useful life to produce a double declining balance depreciation of $45,200. So if we go to the journal entry, it would be a debit and depreciation expense for office equipment of $45,200, credit and accumulated depreciation for office equipment for $45,200. Purpose of this journal entry for depreciation on office equipment. Okay. Okay, so that concludes the problem. P1032A. Feel free to ask any questions, and thank all of you for watching. Look forward to seeing all of you in class.